and move very, very fast to Sebastian Schreiber from local Goethe University here, who had an eagle's eye on our corporate sector purchase program. So let's look what he found. 25 minutes.
Yeah, many thanks. Thanks for having me. Micros on. Perfect. So yeah, this is joint work with Tobias Berg and Rainer Haselmann, who are at Goethe just like myself, and Thomas Kick from Deutsche Bundesbank, which is also why also for this project usual disclaimer applies. So in the broader sense, this aligns with what President Lagarde yesterday said in her opening remarks, when she briefly talked about we have to better understand when you carry out monetary policy in a for the entire Eurozone, but there's a huge heterogeneity amongst Eurozone economies here, and we concretely, as Philip already told, we look at this corporate sector purchase program, so one of these QE measures, but we and the measure was meant to stimulate loan provision, amongst others. And we look at this, how the program unfolded in what we call a credit saturated economy, namely the German one, where at that time we argue there was not really a need of such stimulation. And as the title indicates, this did not come with no consequences or with positive consequences, but with unintended negative consequences that we've spot in the real estate market, as well as with regards to financial stability. Okay, let me introduce the program, which is probably known to most of you very briefly. So in 2016, the program was announced and implemented. The idea is that the ECB directly buys corporate bonds. Think of the large German car makers or so that go to the corporate bond market. The most important criterion here to have in mind is that these bonds must have an investment grade rating, right? There's a couple of other criteria, but really think of large Eurozone companies. What is nice for us, and this is also why we look at this plus it has had a sizable impact to the market. So in the peak in 2022, the ECB held about 350 billion of these bonds. I mean, this is of course smaller compared to the PSPP, for instance, but given that the Eurozone investment grade corporate bond market is also smaller, also for instance in relation to the US one, this is a sizable intervention, right? So this represents about a third of the eligible universe that the ECB held at peak. At the end of our sample, 2019, it's about a quarter. And the ECB, of course, gradually built up their holdings. They did not buy a third of the market in 2016. Yeah, and as I already said, important for our story here, the rationale of the program was to overcome credit supply frictions. And then we argue that, or we inspect how the program evolves in Germany, which we call a credit saturated economy at that time. Let me show you one figure. So in the paper, we have a couple more justifications here. This is from the ECB SAFE survey, and here the question is, or the graph shows the number of or percentage of firms that say that their most pressing problem is access to finance. And if you now look at 2016, which is here when the program was announced, you already see that in Germany, which is the blue bar, or which is the blue line, this is considerably lower, so about 5% relative to other major Eurozone economies and also smaller economies. So we argue here that this is a really economy where all firms that should have a loan, broadly speaking, already had one. And then you come with this program, and we're not the first to inspect this. Let me focus on the corporate QE literature here, because this will help me to build my argument. So what happens if the ECB enters this market, starts to purchase these bonds? Well, the bond yields for the eligible firms decrease. The eligible firms now find it more attractive to go to the bond market for financing relatively to the bank market, where there's no comparable shock, which then leads to a substitution for the eligible firms from bank debt to bond debt. And now it becomes interesting when you look at this from bank's perspective. The previous literature that analyzes the entire Eurozone or or Spain, like the Archie paper, says, well, this is a good thing. These banks, they were capital constrained, and now the CSPP eligible firms, they have lower loan demand, so the banks can finally lend out the money to SMEs that have positive MPV projects, and everybody is profiting. And this is what we kind of challenge or complement, I would rather say, in our paper. We namely argue that the banks would have, at least the German banks, would have liked to continue to lend to these CSPP eligible, therefore investment grade rated large caps. But now these firms have a lower loan demand, and the question is, what do the banks now do with their funds? We use, time period is 2012 to 2019. We use all kinds of granular Bundesbank data. And the identification is hopefully quite straightforward. We also borrow this from the related literature. It's a typical diff in diff, where after is of course after the CSPP and treat. So this is on the bank level here. Treated banks are those among the German banks with a sizable corporate loan portfolio that prior to the CSPP announcement happen to have a large share of their, or an above median share of their corporate loan lending to these CSPP eligible firms. Let me show you here the descriptors, which is probably hard to read because it's directly from the paper, but I just want you to focus here on two numbers, these two red numbers. We split the descriptors for the treated banks and the control banks, both of which there are about 120. And here you say, by construction, by the definition that I just gave you, these treated banks have a higher share of CSPP eligible firms in the loan books before the CSPP was announced, maybe about 13.5%, whereas the control banks barely lend to these firms. And just to get a bit of a better impression of these banks, the interesting part here is that they're comparable in that the return on assets is quite comparable. It's both about 1.8% here. But as these treated banks, again, by definition here, have more CSPP eligible firms in their books, which by definition have an investment grade rating, these banks have a safer loan book, so less loan write-offs in comparison to the control group, but therefore also lower net interest income. The other positions are equal, so this is why they end up here with a similar ROA. Okay, let's go to the results now. So this is just again to replicate the existing literature that I described. So we look at the bank, it's at the bank quarter level, and we look at banks' portfolio composition, and we find that in response to the CSPP, the treated banks that were heavily affected by the program, they indeed face a lower share now of CSPP eligible firms that reduce their lending. And as we do find that the total portfolio size is unaffected, there's indeed also a substitution going on here, which is nice for us because it means the CSPP also worked in Germany as it did apparently in the entire Eurozone and other economies that previous papers worked on. And now the question is, where does the money flow to? So here's again in first column this result for the CSPP eligible firms, which means that about 1.65 percentage points of the corporate lending portfolio is now less to eligibles. But as I will show you in greater detail in the next slides, it's almost fully going to the real estate sector. So firms with an industry classification in real estate, and not much is going on for all other firms. So the substitution is fully going here. Among the real estate sector, we further subdivided into three sub-industries: construction, which is evident what construction firms do, project developers, so these guys, they purchase real estate, then develop it, so engage construction firms, and then potentially rent it out or sell it, and what we call real estate asset managers. So these guys are purchasing existing real estate, also possibly renting it out, but ultimately want to sell it again at a higher price. So this is their business model, right? And we show that, or we find that, again, almost the entire substitution goes to the real estate asset management sector. Let me show you the results I gave you so far now graphically. So these are the different diff coefficients again. So -2 would mean 2% of the corporate loan portfolio here. And if you focus on the blue line first, so this is the eligibles, right? In line with the gradual increase of the CSPP program, we find that the treated banks gradually have less of these CSPP eligible firms on their books. And again, in line with this, we find that this is going more or less all to the real estate sector and not to the other industries. And reassuring, there are no pre-trends. We also have controls and fixed effects and regressions. But this is a good starting point. And now we look at all NACE industries. So these are the different diff coefficients for all NACE industries. Here you have this coefficient that I showed you in the beginning, -1.65. And here you have the coefficient for the real estate asset managers. And for all other industries here, we do not find statistically or even economically large increases in the share. So this really suggests a substitution from banks having no less CSPP eligible firms, but more real estate asset managers on their books. Okay, why is this the case? We here have a small discussion in the paper. So, I mean, there are multiple reasons. So we start with a supply-based argument. Why would a bank lend to a real estate asset manager? Well, because these guys have real estate at their disposal, which they can use as collateral, which is convenient for the bank. And we do indeed find the collateralization by industry is in line with this. These real estate asset managers have an disproportionately high collateralization ratio in our data, but for instance, the real estate developers and the accommodation sector, they also have this. So something else must be driving this, and then we use demand-based arguments. So the idea is that, and we show this in the paper using press extracts from Germany, that the construction sector, which is needed for the project developers, was already operating at full capacity at that time in Germany. So even if they were offered more money, they could not take it because of, or they would not take it because of other, they had not the personnel, or their books were already full. Whereas these real estate asset managers, you really have to think of, if they get the funds now a little bit cheaper, they will immediately be able to purchase another apartment. So this is easily scalable. We now go one step further. Yes, namely if you think through this, so the money goes to this real estate asset management sector. What does this mean for prices? So if the money all went to the construction sector, you might have think that now more and more real estate would be built, right, which would relax prices, supply would increase. But here's if it goes to the real estate asset managers, which is our finding, it's the opposite, right? So this only increases the demand for real estate. And we try to track this down now using spatial data. So the identification is quite comparable, but not on the bank time level now, but on the county time level. So this is comparable to the Huber AER paper. So we have all the counties in Germany, Kreise and kreisfreie Städte, and then we calculate the affectedness for each of those by the firms that are located in these counties, whether these are affected. So this is just what Huber also does. We control for GDP per capita in the county for to have this more equal, and then we again have about 200 of these treated countries, 201 control countries, typical diff and diff, and we start with, like, so to say, first stage. We check do the firms, real estate firms versus other firms in the counties, indeed face, or do they now have more debt? Is the money arriving there, so to say? Yes, this is the case. So the debt of real estate firms in treated districts increases by about 6 to 7%, whereas for the non-real estate firms, not much is happening, which is again reassuring. And then we build on this, again, same econometric specification, but other left-hand side variable, we now look at prices, right? So in Germany, contrast to the US, where people buy houses, is the more relevant and more liquid asset class here are apartments. We do not look at new apartments, but at existing ones. And we find that indeed in the treated countries, where the money flows through real estate asset managers, prices indeed do increase. And when we scale the price by the rents or the income, which are typical overvaluation proxies, we also document increases. So this suggests that this program ultimately led to an increase in the overvaluation of real estate. Here again, the dynamic plot. So this again nicely increases with the CSPP unfolding, price to rent, price to income. And I want to discuss this result now a bit because it's, I would say, one of our main results in the paper. So first of all, is this large? So I showed the coefficient, it's like 3-point-something%. This is of course the average in the post period here. So if you really do the comparison of 2019 estimate versus 2015, this is larger here. This is about 5% rather than 3-point-something. And this is about 17% of the growth in German residential real estate. So it is sizable, I would say. It's of course not, I mean, low interest rates are like the main driver here, but we can say that the program contributed to some extent here. This is a long slide. I will try to make it very briefly here because I think this is an important consideration. One in many of these QE or credit shock papers. Thanks. Credit shock papers. Well, there's a shock and the money flows somewhere, and it also flows to houses or to real estate sector. But it is not the case in our setting here. Here, really, almost everything goes through real estate sector, which is why the elasticity is much higher, right? You do need much smaller shocks to end up with much higher impact on the housing market, right? So the elasticity compared to other papers is much higher here. And this is like the policy perspective here. I mean, the ECB in its financial stability report, it does not have 90% on the housing market as suggested yesterday, but it has a considerable section, and the ECB not just writes about this, but they also take care about this in their policies. For instance, the TLTRO series did not allow for lending to the real estate sector, particularly for these reasons. And this is why we're really sure that this is really an unintended consequence, because the ECB takes much care about the real estate prices, but now via this program, there is some there are some spillovers. And the picture here is just saying this is from the ESRB. It's an ESRB press release from end of our sample period. There were warnings for Germany, a couple of other economies. So this is not, I would say, a pure German thing, but this could basically happen in any kind of economic union. Lastly, so this is in terms of the housing prices or the real estate prices. I did not finish the argumentation on the banks yet, right? I just went to, well, they now go to real estate, but this is not necessarily bad. I mean, you can show the fraction of real estate collateral increases, banks' portfolios become more concentrated, which, of course, if there's a real estate downturn, might be problematic. The main thing here is that, and I will go to the last slide here, these banks now lend to more risky firms, as I just said, right? So they do not longer lend to the investment grade rated CSPP eligible firms, but to non-investment grade rated usually firms, these real estate asset managers, which is reflected then in a higher PD as on the last slide, and ultimately in higher loan write-offs, which makes some sense, right? And now the crucial question here is, can the banks adjust for this higher risk? So can they charge interest rates high enough to compensate for the risk? And the answer here is no, they cannot. The increase in net interest income does not offset this. It's also statistically insignificant. And as not much is happening in all the other P&L positions, we find that this higher or this increase in risk with lower interest rates these lower interest rates are to generally lower rates because the ECB entered as a new player on the bond market, right? That rates dampened generally. And the bottom line here is that in the diff and diff, the return on assets for banks decreases. It's about 6 to 7% of the sample mean. Okay, to wrap this up, the idea is that all positive effects or that you might find in the general for the entire euro area or for certain economies must be weighted with these negative effects, which are capital allocation. So money flows to the real estate sector, in particular the unproductive, the real estate sector, which then leads to an increase in residential real estate prices and even overvaluation. And from a financial stability point of view, banks' profitability also decreases. And I leave it here and I'm happy to take questions.
Okay, first questions come from Caterina Mendicino from us, from the ECB. 10 minutes, please.
So fantastic. So thank you very much for asking me to read this very interesting paper. And the usual disclaimer applies. So these are my own views. So what is this paper about? Sorry, it's not working. Just by quoting the authors, it analyzes the effects of central bank corporate debt purchases when the banking sector frictions they are supposed to address do not exist. In particular, they focus on the CSPP program and they look at the impact on German banks and firms, and they saw that what banks do is to relocate funding almost entirely to the real estate sector, and with adverse effects on house prices and financial stability. Now, just to put things into context, the CSPP is part of the ECB asset purchase programs initiated in mid-2014 with the purpose of strengthening the monetary transmission and ensure that a sufficient degree of accommodation in order to keep price stable, in order to maintain price stability. The CSPP is part of this. Now, here what I'm showing you is the cumulative net purchases. This has been a huge program, but however, the bulk of it's represented by the purchase of the public sector purchases that you see here in blue, and the yellow part is the corporate purchases, which represent around 1/10 or a bit less than the total program. Now, the ECB, as I mentioned, this program was launched in June 2016, was conducted in 2 periods, and the aim was to strengthen the pass-through of the asset purchases to the financing conditions of the real economy. So this was the aim of the policy. What do we know? What do we learn in all this year? So we learned that the CSPP has directly contributed to improve credit conditions for non-financial corporations. On the left-hand side chart, I'm showing you the corporate bond spreads before and after the CSPP announcement. As you see, the spreads have narrowed, not only for the eligible bonds, which are the left columns, where blue is pre and yellow is post, but also for the last 2, for the middle panel and the right panel, which are non-eligible bonds. And in the JFE paper by Todorov, it shows that this relationship is actually statistically and economically significant, and it shows there is an impact both on bond prices and the liquidity of the market. And a more recent paper by Corel, Motta, and Papuzzi shows that the drop in the credit spreads of CSPP eligible bonds, it's almost fully explained by the non-default component, which again reiterates the fact that this was due to the impact of the policy. In addition, we have also learned that the policy boosts corporate debt issuances. So we have seen that in the last part, the increase after 2016 of the issuances, And we also know that this increase was not confined to CSPP eligible securities, but it also supported bond issuance for firms that issued non-eligible bonds. So this was a generalized phenomenon after the policy. Now, we have also learned that this policy has important indirect effects because it affects also bank lending. And in general, the APP programs had a positive impact on bank lending. But when it comes to CSPP, we know that it incentivized firms to substitute bank loans with eligible bond debt. But it also led to an increase in bank lending to NFCs, which had no access to bond-based financing. So essentially, the policy also benefited sectors that couldn't directly benefit from the program, such as SMEs, which are the bread and butter of the bank business models in the euro area. Now, so overall, I think we have already lots of literature showing that the program was successful in its aim. And now, where this paper comes from, basically they focus again on this corporate state program. They focus on Germany, so they look at German credit register data, which only have loans above 1 million issued by German banks. So we are talking about large type of loans. And they focus on a carefully designed difference in difference approach, which where they exploit the ex-ante cross-sectional variation in bank exposure to the firms with at least one bond eligible for the program. And then they split the banks into treated and control, looking at above and beyond median exposure. And they look at the effects on bank lending, real estate prices, and banking sector stability in a very careful way. Now, one of the main results is that the CSPP induced relocation of loans from CSPP eligible firms to real estate asset managers. So this is something new in the perspective of what we had already learned. There is not only relocation, but this relocation in Germany happens to a particular sector. And here, what the author shows that the treated banks allocate about 7 billion to this sector. Now, okay, I would have liked to learn a bit more. Is this a lot? Is this a little? How much it refers related to the size of this sector and the size of this sector in banks' balance sheet in particular. And then they also show another interesting results. And so basically up to here, I guess it's all fine. These are still SMEs, so they still benefit. It's okay, nice result. But then this has implications for real estate prices. And what the paper shows is that this increased exposure to the real estate firms contributed to the overevaluation of real estate prices and price to rent ratio. And in particular, in the aggregate, it contributed to 5%. It produced account for 5% cumulative price growth by the end of 2019, which is not the bulk of it, but it's a relevant size, I would say. It's like where the author reported the total growth was 29%. And this, they also argue that has severely impacted the banking sector stability by reducing average probability of default and industry sector by increasing average probability of default and industry sector concentration and declining bank profitability. Now, I really enjoyed reading these papers. My comments would be mainly on the channels. So I would have liked to learn a bit more insights about the channel. So one possible channel for why banks substitute loans from eligible firms to this real estate sector, and in particular to real estate asset managers, is one possibility is that this is a safe option because these firms can provide lots of collateral. And the author saw the collateral at the industry level, and also the treated banks now have more collateral. One suggestion would be to actually formally test this because you have information in the on the collateral, on the loan type and the loan collateral in the credit registry. So I think it would be more convincing to run your loan level type of analysis on this. The second possibility is that it comes from demand side, meaning these asset managers are really responsive to credit because they are small and they have limited financing options. I find this extremely plausible because I have a paper that shows that tests the sensitivity of firms to monetary policy change formally and shows that this is correlated with firm size and age. And I would just suggest to run the same test because it's pretty straightforward. You could run it with your data. It's again a loan level type of analysis where you look at the beta coefficient in the response to the policy rate for each firm you have in your sample. And here you can formally show that it's really these type of firms that are more responsive to monetary policy compared to any other type of small firms. And finally, you also mentioned that these are riskier, unproductive firms with fewer financing alternative. And here I wonder if there is a role for relationship lending type of rationale behind bank incentives to lend to specifically this type of firms rather than others. And for what concerns the impact to asset prices, so I was wondering, it would be nice to show, it's like, oh, okay, I was a bit confused. What exactly is the channel here? Is it because these firms buy more apartments, then now the price goes up? If this is the case, you could show us that look at firm level outcomes, for instance, on increase in investment by this type of firms, and especially in these counties with higher price growth. Or is it more a story about mortgages? This was not super crystal clear to me. And finally, when it comes to, I understand the concentration, and now this is banks are more vulnerable to asset prices, and perhaps this could be the perfect experiment to see what happens in recent years when there was a turn in house prices in Germany. And thank you very much. I really enjoyed reading the paper, and I suggest everyone to read it. But I wish to learn a bit more about the channels. Thank you.
Thank you, Caterina, also for recalling the objectives and the broader context of the program. So I first try to take the questions and then give you the floor back. I know you're all tired by now, but what about waking up the online audience? Okay, here we go. Now we go. Okay, so I think you were first. Please state your name and affiliation if you could.
Hello, Radu Popa from the ECB. I have two questions. So first of all, you have credit registry data, but I understand you consolidate on bank level. Why not keep it at the loan level, and then you could do some more things about, you know, intensive, extensive margin? It could be more detailed. And second of all, about reallocation to mortgage loans. Can you look if maybe they shifted from corporate lending to mortgage lending to households? Thank you.
Simone was the next, and then Livio.
Simone Manganelli, ECB. I was wondering whether you have a sense of how heterogeneous the results are across other Euro area countries, and if there are different impact in the other Euro area countries. Does your paper provide arguments to deviate from the capital allocation keys in the implementation of these purchase programs? And so you want to have distinction according to where you are in the level of interest rates in different countries.
Livio in the front here was the third.
Thank you. First of all, I really like the paper, and I kind of, it strikes me as plausible overall. So just to say, but it's not very scientific, but it sounds right. But then, you know, I guess it's a question more of interpretation. I guess also the discussant had a bit the same view, if I understand correctly. But so so it's a bit a question of interpretation. So essentially, what seems to be you are saying is that if there is a credit supply shock, there are conditions in which these credit supply shocks then translates more into real estate prices. The question of Caterina is why it is the case. So it's not really about the question of this particular program, but it's more a question of, you know, it may be bad to have a positive credit supply shock when credit is already abundant. And this may be applied to other shocks or other countries, other situations. So it's not really specific to the CSPP. But tell me if you agree with this interpretation. Thank you.
If there's no other questions, so please, you have
Okay.
5 minutes, 6 minutes.
Thanks. Thanks for the great discussion. So yeah, I think you really nailed it with currently where we're at, that we are trying to pin the channel more down, where we also think it's plausible, but in the end, it's yeah, I think we have to do a bit more. The test that you propose to disentangle demand and supply sounds very interesting. So this is definitely also feasible with our data. I first thought it would be something with interest rates on the firm level, which the German credit register does not have. But this is really, as far as I understood it, the market interest rate that applies to any firm. Then mortgages, I think you had it, and you also. So we have this in an appendix table where we check whether the money flows out of the corporate bond portfolio, corporate lending portfolio, be it to the securities or be it to mortgages or other kinds of investors. And this is not the case. This is also what the previous literature finds. I mean, otherwise these papers they would not really work. You can discuss why this is the case, but we're building on this, so to say. Yeah, we also, I mean, if we had known how after 2019 everything would evolve, we would have stick to this and extended the sample further. But I mean, now we're also a bit happy that free to COVID it ends and we have a clean message here. I'm not sure how I think it evolves in when the interest rate reverses. I mean, you could argue now. We had a situation, right? The interest rate sharply increased then, but it was not like there were huge defaults or so. So it's of course dependent on many other factors. One thing I wanted to say in the presentation, maybe it's appropriate here now, that there's a macroprudential conference, or the macroprudential authority in Germany, the BaFin also increased the capital buffer for residential real estate lending, but only in 2023, so 4 years after what we find here. But this would maybe we do another paper where we analyze how the reversal works. Then for the questions from the crowd, so on the loan level analysis, we also do analysis, which are also in the appendix. We do a typical Quadramian stuff, or also the Amiti-Weinstein specifications to disentangle supply and demand. And these also work through, but as this is our main message, is really on the portfolio shares, which are then easily comparable for all banks. I mean, you have on the if you do use the full credit register, you have some banks dominating and other issues, but I can hopefully assure you that the typical tests go through there, so it's not that there are weird things going on the loan level. As I said, I have in the paper. Then for the entire Eurozone area, this is also something we have on our list. So luckily, the discussant at the EFA already did this to some extent, plotted some countries, some also based on the SAFE survey. So to what extent banks were facing financing conditions in an economy versus the increase in lending in real estate, and this went through. So I think she had 6 or 8 countries, and the correlation was just as we find it. So also for other countries, but we plan to extend this a bit more to be really on the safe side there. because I also think, and this is coming to the last question always a bit, I think this should be generalizable to other currency areas. I mean, not even in the Eurozone where you have many countries, but also within countries you might have weaker or areas where the loan demand is more met. And yeah, regarding shall we change capital keys? I mean, this is a bit, I would have to think about this. I mean, as a background, for the CSPP, there was no deviation from market neutral buying, right? Because the CSPP was greened. So brown firms are now disproportionately bought. You could also implement this. I mean, in our story, it would not work to the extent that real estate firms, they are rarely eligible anyways for the program. So you cannot just say, well, to mitigate these effects, we don't buy any, do not allow for CSPP eligible real estate firms to be bought. This would not be the case. But as I said, this I would have to think about this a bit more. And lastly, yeah, is the CSPP specific the shock? I mean, as I said in the beginning, the CSPP allows for a very nice identification here. I think when I now say, well, this of course all applies to the PSPP and we can scale this by a factor of 10, I think this would be too much, but I think the underlying rationale is comparable to that of the CSPP for many other programs. So this might be well beyond the CSPP, but we here leave it with this.
Thank you very much. So let's give the authors a hand as well.